Well, it was a pretty quiet end to the week. S&P 500 was down just 0.26% today. However, it did close with a bullish intermediate confirmation signal using the market forecast indicator. We also saw the Russell 2000 nudge up to yet another set of all-time highs. We saw interest rates pull back in yield. Of course, that means bonds went up. We did discuss yesterday's oversold cluster on TLT, so had a little bit of a heads up that that could have been a possibility here today. Industrials led the way higher, and of course, yesterday's trade application example, Boeing, was a big reason for that. And today we're going to be talking about an oversold sector that was really beat up today due to one CEO leaving a prominent company. But there's another company that I've been keeping my eye on from a dividend perspective that might have some appeal. So let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's May 18th, 2018. For those of you that are new, first of all, welcome aboard. Grateful to have you here in our audience today. Feel free to click subscribe if you want to be alerted whenever David and I upload these videos to YouTube. You're also welcome to give us a thumbs up if you appreciate the effort that goes into producing these, and also leave some comments down below. In the description area, you'll find a link that you can sign up for our email distribution list. That'll let you know whenever we're posting these videos, and then also give you a heads up as far as which companies are giving you overbought and oversold clusters within the S&P 500. Now, in addition to YouTube, we're also heavy users of Twitter. Feel free to follow me. My handle is @BrandonVanZee, and I do appreciate all of you guys going to work for me this week. Every single day we got over 100 likes, and I knew you had it in you. I didn't know you had this much in you, but as a reminder, that's one easy way to let David and I know that you want us to continue to do these free videos. Obviously, we're running a business now, and we've got a lot of different places where we can go direction-wise, and we got to make sure that our time is well spent. So please continue to do that going forward as well. Now, we also have a presence on Facebook. You're welcome to join our group there. You can see the address on the screen in front of you. With that, let's go ahead and do some analysis on the markets. As you can see, I've got the S&P 500 pulled up here. And as mentioned before, we were down 0.26% here today. Not a big pullback by any means, but maybe just a little bit of a cooling down after a pretty dramatic rise from our lows just a few weeks back. Remember, it wasn't too long ago, we were just a hair below 2,600 on the S&P 500. So the fact that we're up here above 2,700 in such a short amount of time does go to show you that the markets have been somewhat resilient. As mentioned before, we do have what's known as a bullish intermediate confirmation signal that exists on the S&P 500 right now. As a quick reminder of what that means or how it's established is using that market forecast tool that you'll see down below. It's an indicator that you can pull up on the Thinkorswim platform. What we're looking for are the two different things. First of all, the green intermediate term line, which we normally use to establish our posture. So as a reminder, we have a bullish posture right now. Green line is in the upper reversal zone, but we'd also have a bullish posture if the green line is simply just rising between the 20 and the 80 markers. So we do have that bullish posture using the intermediate term line. Remember, you can also see that by just looking at the background color of the chart here currently. So that is combined with the red momentum line in the lower reversal zone. Now for that one, it can't just be traveling lower. It actually has to be below 20 in order for this particular signal to exist. So bullish line on the intermediate term green line and that red line in the lower reversal zone. Now, as you've heard David and I discuss in the past, we've found that in the past, although the blue line is not part of the bullish intermediate confirmation signal, we found that it oftentimes works better if that blue line is positioned somewhere between 20 and 50. And that is what we have right now. So this would be maybe a slightly better setup than if that blue line were somewhere else on the chart. So keep that in the back of your mind. The idea of the bullish intermediate confirmation signal is really a buy the dips mentality. It means that we currently have a bullish posture on the market. This would be an opportunity to finally take advantage of that on a slight pullback without breaking the uptrend. So the pullback that we've had is this 2-day pullback here recently. And the expectation is that we will continue to drift higher in the weeks and months to come. Remember, when we're looking at the intermediate term posture, that's really an intermediate time period, meaning the next couple of months. It doesn't guarantee anything about tomorrow or next week or anything like that. But right now, that period posture, that intermediate period posture would be bullish. Let's take a look at the other three indices on our 4 grid here. This is chart 4B for those of you that are following along at home that have gone through my charting tutorial. Remember, you can always spot that in the pink label in the upper left-hand corner of the charts. As mentioned in the intro, we did have yet another all-time high in the Russell 2000. So, it's clear right now that the money is drifting towards the smaller cap arena in this current marketplace. Remember, that's not always the case. In fact, we had a long period of time where the Russell 2000 was an underperformer versus some of those big cap indexes. But right now, this is a time for the small caps to shine. And again, one of the features of this chart is anytime one of these indices hits a new yearly high or low, we will get an additional label to show up. Notice that the Russell 2000 is the only one that gets that label right here. If the Dow Jones would have gotten a new high, it would show up right here, but you can see it's blank in that area. So just one more way to remind the eye that, hey, something special is happening here. It could be a potential breakout that's taking place. As we look at the other indices, you will notice that we do have a bullish intermediate confirmation signal down below here in the lower left on the NASDAQ as well. And like with the S&P 500 that I mentioned below, we do have that near-term line in between 20 and 50. So maybe a slightly better setup there than otherwise. In general, we do have bullish markets across the board, again, from an intermediate term time period. For those of you that are day traders, that may not be as effective for you, but for those of you that are intermediate term trend traders, do assume that we have bullish market conditions to place those types of trades. As we look at a few other charts here, let's take a look this time at chart 4C. This is our 3 green arrows chart. 3 green arrows meaning the 30-day moving average in the case of these charts, the MACD, and the stochastics. And what we're looking for are bullish signals in each of those 3 indicators. And as it stands right now, all 4 of our indices here, the S&P 500, Dow Jones Industrial Average, NASDAQ, and the Russell 2000, all 4 of them have 3 green arrows. And again, for this particular chart setup, which is chart 4C, you can see that by looking at the background color shading, and if you need to verify it with your own eyes, just as an example here with using the Dow Jones, we got the green arrow when price went above the moving average. We got the green arrow on the MACD when the MACD reading went above the 0 line, and then we got a phantom green arrow down here on the stochastics when it kind of came down to that lower reversal zone and then reversed back higher. Moving right along, let's now take a look at chart 4D. Remember, this chart is especially important on a Friday like it is today. Normally, David's with you on a Friday, so this is kind of a rare treat for me to be with you here on a Friday. But, of course, David's on vacation right now. We'll be back next week. As we look at this chart, the reason it's important on a Friday is because this is a weekly candle chart. So really the candle is not set in stone until Friday's close. Well, now we can officially say what has happened for the week. So as we look at these particular charts, let's maybe kind of go through them one at a time. I'm going to right click on the S&P 500 chart and I'm going to go to maximize sell. And you can see that we did close lower on the week for the S&P 500. That's what that red candle is telling us right there. But what we're really looking for with this particular chart setup is, are the moving averages crossing over each other? This is our 1040 crossover method chart. This orange line that you see up here is going to be your 10-period exponential moving average. The blue line will be your 40-period exponential moving average. It's a way for us to get a determination on longer term posture for those of you that have money that you can't move around very often. So for example, 401k money may be sitting in a mutual fund somewhere. What we're trying to do is not time the bottom or the top when we're getting in and out, but what we're really trying to do is capture that meaty part in the middle and be part of that trend that can exist for quite some time. You can see the last time we had a crossover was way back here. And this would have been in April of 2016. That orange line, which is that 10 period, crossed up and through that blue line, and that's when you would have gone bullish, and you would have stayed bullish until today. Now, obviously, the S&P 500 at that time was somewhere around 2,000. With the S&P 500 around 2,700 right now, you'd probably be pretty pleased with that performance over that time period. Let's take a look at another chart here. This is the Dow Jones that we're looking at. Again, the Dow Jones was down today as well, but prices are holding up enough for those moving averages not to be anywhere near one another. If we look at the NASDAQ now, again, NASDAQ was down here this week as well with that red candle. We got to be a little bit more careful with those. Remember, we did get one that looked somewhat like that back here on May 5th and then into May 12th, those 2 weeks. So we got to be a little bit careful that we might have a little bit of short-term hiccup there. But again, from a longer-term perspective, which is what we're looking for in this particular chart setup, the orange line is way, way, way above the blue line. We have nothing to fear from a longer-term posture-changing perspective. And then the Russell 2000, that's been our champ here lately. Notice that the Russell 2000 was the only one of the 4 indices here that closed up on the week. In fact, we closed near all-time highs at the close of today's session. Look at that nice clean breakout on the Russell 2000. So if you're looking for strength within the United States markets, clearly it is in the form of the small cap universe at this current time. So feel free to push into that particular trend if you're looking for momentum. Let's go ahead and take a look at a few more charts now. Let's do some 12 grid analysis at this point. Let's look at the intermarket analysis. And for this, I do have to kill that camera feed. For those of you that like to look at the VIX, here's your VIX in your upper left right here. Notice that, again, very, very quiet day. There hasn't really been a lot to discuss out of the VIX this week, to be honest with you. We're sitting at 1342, which on a historical basis is very low. It's not as extreme low as we saw late last year, but anything really below 20 from a historical perspective had been considered low in the past. Maybe this is the new normal. But again, what that means for your options trading ability is that this may be a time where buying puts and calls is a little bit cheaper for you, and you might decide to stay a little bit further away from selling puts and calls, depending on what your goal is. Now, as I alluded to in my question and answer session here today, for those of you that were in attendance of that, you know, there are going to be times when you're selling credit spreads or you're selling puts, and remember, that's still going to be a high probability trade, even if the VIX is low. So it's not as if that somehow eliminates the appeal of the trade. It's just that it is slightly less desirable than it would have been if the VIX were a little bit higher. So, you know, keep that in the back of your mind as well. Here's what I mentioned in the open. You guys will recall that yesterday when I was going through this particular 12 grid setup, I mentioned that the TLT had a oversold cluster signal. And we talked about how the last 2 times we had those oversold cluster signals, if we right click on that chart, go to maximize sell, over here we had a reversion to the mean higher, and then over here on April 25th we had a reversion to the mean higher, and I said I wouldn't be surprised if that played out yet again, and we did get a taste of that today. Now, who knows where that takes us, but we do know that for sure, this was a very, very nice bounce out of TLT. We had a 0.86% bounce higher in the long bond. That's a pretty aggressive day. You can see that the size of that candle is one of the bigger ones on the board. It's not the biggest one, but certainly above average range that we got today coming out of that oversold condition right there. So who knows, maybe there's going to be a little bit of wiggle room to the upside. And even if this trend is to hold, meaning the trend of higher rates and lower bond prices is to hold for longer periods of time in the future, that doesn't mean that we can't get a momentary shorter term pop right here, right now. So who knows, maybe we're starting to see a little bit of that play out at the current time. Going back to the 12 grid, of course, that means that interest rates themselves did fall. So notice that on the 10-year, we're back to 3.06. Boy, that happened in a hurry, didn't it? We were just at 3.10 yesterday. And so we did lop off quite a bit there in just one day. So a little bit of a reversal pattern taking place there on interest rates that you might want to be aware of. Down below, you'll notice that gold did get that little pop. We talked about those oversold cluster signals here recently. Was not a big pop, so I don't want to make too much out of it, but it did rise about 0.25%. So we're keeping our eye on the dollar. The dollar has remained resilient, as you can see off to the left-hand side on the lower column, or the lower row in this case. Dollar remains strong, so the gold move was kind of fighting that particular headwind at this current time. We did have a little bit of a pullback in crude oil prices, and holy cow, we actually had energy stocks fall for like the first time in a couple of weeks today. We'll get to that here in just a second. Before we do, let's go ahead and take a look at our foreign market 12 grid. That's chart 4F for those of you that are following along at home. Yikes. Brazil got crushed yet again. I talked about that yesterday. We reviewed that in my strategy lab class on Wednesday night as well. They just can't buy a bounce at this point. I will say that they at least got a decent looking candle. Now, they were still down 2%, so we don't want to go on record saying that was a bullish day. But when you look at this shape of this candle down below, at least that gives you hope that maybe there was some capitulation that was taking place there. The bulls did kind of push the EWZ in this case up near the highs of the session. It was still down 2% from yesterday's close, but it was one of the higher levels of the session. So who knows, maybe Monday we start getting a little bit of a reversion to the mean. You can see we got very, very close to getting a cluster here today, an oversold cluster, but we weren't quite there. So who knows? We'll have to keep our eye on it. But at this point, this thing is so far away from the moving average. We're close to a cluster signal, and we had a fairly nice response from the bulls intraday that maybe we're due for a little bit of a bounce out of Brazil starting next week. As we look at some of the other charts on the board, Mexico continues to be a very difficult place to be an investor. A lot of conversation about NAFTA these days, of course, and what the U.S. will or will not do in order to keep that intact. Last we heard that we're a long ways away from an agreement on that. So that continues to pressure Mexican securities. We do have an oversold cluster there on EWW, but given the headline risk, that might be a little bit of a dicier situation to kind of sniff around in. You will notice that Canada is holding up a lot better in these talks, apparently, at least if you're judging it through the lens of the stock market. Canada has actually been a fairly strong player here recently. And then, of course, who could forget the United Kingdom? All eyes are upon England this weekend, of course, with the royal wedding taking place. And so I don't know if I'll be setting my alarm to watch that on NBC, but maybe some of you will. What we do know from a stock market perspective is that money is moving into the United Kingdom. That's a pretty good looking chart there from a foreign markets perspective. Maybe not quite as good as the Russell 2000 here in the United States, but certainly when you compare it to a lot of the other equity markets around the world, United Kingdom is looking pretty strong at this current time. Let's go ahead and take a look now at our U.S. sectors 12 grid. And maybe before we do that, let's pop over and just see what's happening on a one-day basis. Got those sectors pulled up here on the Market Watch tab, and you can see that we were led higher by the industrials today. They were up 0.59%. And of course, financials on the downside because of the interest rate environment. But boy, I just can't tell you how much that annoys me that for the fourth straight time this week, I've been shut out of a trade. Now, those of you that watched the video last night knew that the trade application was selling a put spread on Boeing. And you guys got to stop front-running my trade ideas. And of course, I'm just joking because we're not going to have the ability to push a stock like Boeing higher. But it is very odd to see how this has shaken out for me this week. Boeing was one of the leading stocks in the entire market today, up 2% today. So we did not get filled on that trade. So it's been a peculiar week from that perspective. I think it was Tuesday, I was trying to do the bullish trade on Adidas, and Adidas popped higher to start the next day. We did not get filled on that. The next day, I was trying to do a bullish trade on KOL, that coal ETF. Lo and behold, it popped higher the next morning. We did not get filled on that trade idea. I taught a class, a strategy lab class, for those of you that are my premium subscribers that night, and we tried selling puts on a consumer staples company, and it popped the very next day, and we did not get filled on that trade. And then that leads us to right now on Boeing, which I conducted in last night's market outlook, and it popped higher today. We did not get filled. So that's 4 straight trades that I should have been filled on according to the analysis that I was doing, but because I'm conducting the analysis the night before when the stock market is not open, I had no idea what would happen the next day. So I'm bringing this up because it's a reminder that if David and I ever get to a point where we're able to conduct these classes or this presentation live when the stock market is open, we can much more assure that our trades are actually going to get filled. So for those of you that are premium Market Scholars subscribers, we will plan on making that available to you when we can figure out the logistics of that. So stay tuned on that. For those of you that are not premium Market Scholar subscribers, then you'll be kind of relegated to finding out after the fact, like is currently set up with our current iteration. So anyway, that one is a little bit of a pet peeve of mine. Let's actually try to get a trade filled tonight when I do my trade application. So Boeing was one of the leading stocks. I'll also mention that John Deere was a leading stock within the industrial space today, helping support XLI as an investment. Let's go back over here to our charts now. Take a look at what's kind of shaking from a longer term perspective. Remember, this is a 3-month view of these charts as opposed to just 1 day. So as we look at the kind of the 3-month views, notice again down below industrials. That's your chart in the middle off to the left right there. We've actually had 3 or 4 straight up days and kind of put in a mini higher high. We had this lower highs and lower lows shaping up in the industrials. A lot of people were nervous about some comments from Caterpillar in their earnings announcement a few weeks back. Ever since then, industrials have actually been one of the leading areas of the market. And while we haven't quite gotten up over this hump right over here from 419, we at least got over this miniature topping out point. So that's a starting out point from May 14th. And so if this turns out to be just a 1 or 2 day pullback right here, followed by about a 3-day upswing, and we end up getting up and over this area, that's going to be a very nice setup right there because this is a much higher low than what we put in over here. So keep your eye on the industrials. They've been working reasonably well here. We've mentioned the materials this week. That's another area that continues to be somewhat robust. Of course, we've been talking ad nauseum about energy. You know, it's hard not to when the chart looks like this, basically hardly any pullbacks at all in energy. But notice what's been happening with energy recently. Let me right click on that and then go to maximize sell. Notice that we had 2 what's known as overbought cluster signals. Now, in some of the research that I've done in the past, I have found that the oversold cluster signals, the green dots that you'll see on the charts occasionally, typically have a better hit rate, meaning that they do revert to the mean more often than the overbought clusters. Now, my research was done on the S&P 500, so I can't necessarily say that's always the case for XLE, but just be a little bit more cautious on those. What this is saying is that we've had an extremely aggressive move higher. At this point, the chances of XLE going up at the same rate in the coming weeks as it has done in the last couple of weeks is probably a lot less now that we've already made that move. So does that mean that it has to go lower or that it has to go sideways? No, it could still continue to drift up. It's just not going to likely go up at the same rate that we just saw out of XLE. That was a tremendous move that got us into these overbought cluster signals right here. So keep your eye on energy there as well. All right, let's now get into our trade application example. And for it, I want to first highlight the fact that there was one stock today, Campbell's Soup, that got just blitzed. Campbell's Soup was down 12%. This is supposed to be a boring soup company. You usually don't see that type of a company down that much in 1 day. They came out, slashed their forward-looking guidance, and they also had their CEO unexpectedly resign. And so a little bit of turbulence there in the consumer staples space. Many of you are aware that consumer staples have been getting absolutely kicked in the teeth here a little bit earlier this year and really up until recently, largely because of the interest rate environment. But of course, there's a lot of other potential threats out there as well. You know, Amazon is certainly a threat, which is, you know, the consideration of private label shopping type of a thing. You're also finding that just the ability of consumers to shop online and get products delivered to their doorstep has kind of changed the types of brands that consumers are buying online as well. So a lot of different things kind of affecting the consumer staples right now. But one of the things that you might know, at least if you've been to my classes in the past from a dividend perspective, is that consumer staples are actually the best sector from a dividend growth investing perspective. Now, how can I make that claim? Well, if you look at the Dividend Aristocrat list, which is a list of currently 53 companies in the S&P 500 that have raised their dividends for 25 years in a row or more, almost a quarter, last I checked it was like 24%, but basically a quarter of the entire index is a consumer staples sector. So they have shown, at least historically, a greater ability to raise dividends for at least a quarter century more than other sectors that are out there. So one of the stocks that I wanted to look at today was Kimberly-Clark. And for this, I want to bring up chart 4A. And this is the Market Scholar's dividend stair-step chart here for those of you that are following along at home. And as that loads up, let me type in KMB. That's the ticker symbol for Kimberly-Clark. Now, for those of you that aren't familiar with Kimberly-Clark, this is the company behind Kleenex and a whole bunch of paper products that are out there. So as you look at this chart, some of you are familiar with this, some of you aren't. For those of you that are not familiar with it, let me just explain one quick thing. Let me kind of zoom in here on the last several years, and you can see that there's this orange stair-step line on the chart. That's the most important line, at least from my perspective, on this particular chart. What that orange stair-step line represents is where a stock would need to be priced in order to be yielding its average high yield. Now, what I'm using for an average high yield is effectively what its highest yield was in each one of the previous 10 calendar years and then averaged out. So in other words, I know that's probably a confusing conversation for some of you that are not familiar with dividend analysis, but let me kind of explain it to you this way. Up in the upper left-hand corner, you're seeing this black yield label, and it says Kimberly-Clark is currently yielding 3.86%. Now, of course, this is one of those 53 dividend aristocrat companies. For those of you that want that full list, you can find it on the Market Scholars website if you are a premium subscriber in my sector watch list tutorial. But anyway, Kimberly-Clark has raised its dividends for basically 50 years in a row. So they go well beyond the 25 needed to be on the dividend aristocrat list. Currently, they're yielding 3.86%. Remember, the S&P 500 right now is yielding less than 2%. So this is a company that's yielding almost 2 times as much as the broad-based index out there. What this orange line is representing down below is kind of matched up in a color-coded fashion with these orange labels up at the top. You can see up here it says average high yield for Kimberly-Clark specifically is 3.85%. So remember, this number is going to be different for every dividend stock that you pull up because every dividend stock has its own unique yield history. Notice that translates, this over here, this next orange label, it says AHY, which just stands for average high yield. The price of the stock would need to be $103.90 at the current dividend rate in order to have a yield of 3.85%. So in other words, the current price of Kimberly-Clark up here is 103.67, which is lower than 103.9. In other words, its yield right now would be viewed as attractive compared to its historical ranges. Now, you'll notice that as you look at price action over the years, the last time you have had an opportunity to buy Kimberly-Clark up until these last few weeks at an average high yield of 3.85% would have been way back here, right here, this level that I'm kind of circling with my mouse right now. That would have been back in April of 2012. So we're talking, you know, literally 6 years ago was the last time you would have had the opportunity to buy Kimberly-Clark at a yield of 3.85% or more. So you can see that recently we have been getting a few cluster signals on a weekly candle basis. That's what those green dots are on the chart. Not only that, but it's not like Kimberly-Clark's business is falling apart. Notice down below we have this earnings per share trend that's plotted on this particular graph as well. And what this green box means is that, first of all, the earnings per share was higher than the previous earnings per share. This blue arrow right here means that they beat the analysts' expectations on their most recent earnings announcement. You can see right here they put in 171 on an actual basis, and they were expected to report 170. So it wasn't a huge beat, but at least, hey, they're beating the expectations, and earnings per share are literally at all-time highs. Now, in addition to that, valuation is as cheap as it's ever been. Notice down below here in this kind of brown area, it says PE ratio 16.27. And I've got this plotted along so that way we can see from a historical perspective what does that mean? Because remember, a PE ratio of 16 can mean a number of different things depending on what type of a company you are. So for this, let me kind of give us a little bit more room. And you can see that where we stand from a PE ratio perspective right down here at 16 times earnings basically takes us back to 2012 as well. We did have a period of time where we were trading down there closer to 12 times earnings, but that would have been way back in 2010, 2011, when we were just kind of emerging out of that financial crisis. So this is the cheapest it's been on an earnings basis in 6 years. This is the highest dividend yield it's had in 6 years. And this is a company that has basically a half a century's worth of dividend increases under its belt. So a lot of interesting things going on there with Kimberly-Clark. Now, what it doesn't have going for it is price momentum. So anybody who does a bullish trade on something like this really has to think like a long-term investor, the type of thing that I preach in my dividend growth investing classes. This is not for those of you that are momentum-based traders that are looking to make a quick buck from 1 week to the next. So be aware this is a longer-term, higher quality company. And for that type of a stock, I traditionally like to look at selling puts because it allows us to look at buying the company at an even cheaper price than where it's at right now. Again, this is a company that's trading at about 103.67 right now. If I come over here to the trade tab, notice that if I pull up the June monthly contracts, the ones with 28 days till expiration, there's a $100 strike, which is a nice round number. Might find some buyers coming into the market just simply because they call up their broker and they say, you know, buy me 1,000 shares at $100. So that sometimes that can happen. But notice that the last traded price of that particular $100 strike was 104. I've got this last column right here, so that was done today at 104. And you can see that we've got decent open interest in there, about 387 contracts. And maybe not ideal, but for selling puts, which is a single leg strategy, it's certainly good enough. So that's what I'm going to focus on. Now remember, if we are to get filled at a $100 strike, or I should say get put the security at $100, remember if this thing falls between now and June expiration, and let's say it's trading at $99 on June expiration, then we are basically committing ourselves to buy 100 shares of stock at $100 per share and spending $10,000 on this. So if we do get filled at that price and we get put the stock at that level, remember, $100 is our strike price, but we're going to try to get filled at $1. Remember, the last traded price was 104, but we'll try to get filled at slightly less than that come Monday morning when the market reopens again. So in other words, if we took 100 minus $1 of premium that we're going to receive, our break-even price would be $99. So I'm bringing this up because our yield up here of 3.86% would actually be enhanced further if we're getting filled at this price of $99 as opposed to where it's trading right now at 103.67. So if we wanted to figure out what our yield would be if we were to be put this security at that break-even price, what we'd want to do is take the current dividend amount. Now they pay exactly $1 per share. So you can see $1 per share quarterly. So you can see the dividend frequency right up here. So we would take, sorry, $1, 1.00 times 4, because we need to annualize that. So in the 4 quarters this year, they're going to pay $4 per share. So we take that number, divide it by $99, which is our break-even price, and our yield, our starting yield on cost would be 4.04%. So not 3.86 that is showing up here. We would literally be locking in 4% on this high-quality company. So with that, let me go ahead and place the trade. I'm going to go ahead and click on the bid price right here. Now it's going to put in 85 cents because they kind of widened out the bid and the ask after hours here. But again, remember the last traded price was 104. We're willing to get filled a little bit lower than that at $1 if the market will give us that opportunity on Monday. So with that, let's go ahead and click confirm and send. Review it one last time. Everything looks good there. And again, as a reminder, you got to be willing to be a long-term holder of this company. And so if you don't like Kleenexes for some reason, or you think consumer staples are going to be on the outs for years, this is not a trade for you. But for those of you that are dividend-oriented investors, this very well may have some appeal. So with that, let's go ahead and click send, and we'll see if we can get filled on that on Monday morning. All right, well, I want to thank you for joining me here today, not only today, but all week. It's been fun to to get an opportunity to work for you. Thank you for inviting me into your home offices, and for being excellent towards me regarding some of the likes and the thumbs up and all of that. Again, we're trying to judge whether these free videos have value for our students or not. You guys have stepped up to the plate this week to let me know that many of you do find value in these free videos, and I'll be sure to relay that on to David when he's back from his vacation as well. But don't forget to continue to do that going forward, because as we see those numbers drifting lower, then we start wondering if we should start changing our business model as well. So anyway, thank you for putting up with me all week. I hope you learned a thing or two. I'll look forward to joining forces with you likely on Tuesday. Again, David should have you on Monday, assuming he is back from his trip in one piece. So with that, have a great weekend. Hope you get out there and enjoy some wonderful spring weather, and I'll see you all next week. Take care, everybody. Bye-bye.